Hey everyone, welcome to the Crypto Pump channel, where we break down crypto in a clear and practical way, help you build confidence in trading, and avoid blowing up your account on rookie mistakes. Today, we're diving into one of the most powerful topics in trading, and you're about to get a truly valuable guide. In this episode, we'll take a close look at how futures trading on Bybit works, a tool that lets you profit from both rising and falling markets, using leverage up to 100x. You'll learn how to open long and short positions, how to use market and limit orders, and how to set up stop losses and trailing stops to keep your risks under control. We'll also talk about liquidation, how it happens, and why you need to be extra cautious when trading with leverage. This is a detailed, hands-on breakdown, especially useful if you're just getting started. Want to go deeper into futures and get proven strategies? Make sure to join our Telegram channel. You'll find fresh guides, tips from experienced traders, and an active community where you can ask questions anytime. The link's in the description. Come join us. It's going to be both interesting and useful. What are futures and how do they work? Futures on Bybit aren't about buying cryptocurrency. They're contracts with the exchange where you're making a bet on price movement. Imagine this. You agree to take Bitcoin at today's price sometime in the future. If the price goes up, you earn the difference. There's no need to actually buy coins. You're simply trading the direction of the market through a contract. Originally, futures came from agriculture. Farmers would lock in prices for their crops ahead of time to know how much they'd earn. For example, they'd agree to sell wheat in the fall at a fixed price, no matter what happens in the market. In crypto, it's even simpler. You don't hold the asset. You're betting on whether it will rise or fall. On Bybit, futures let you react quickly to market changes. You're not buying crypto and waiting for it to grow. You're opening a position. If your prediction is right, you profit. If not, you only lose what you put in. Think the price will rise? Open a long. Expecting a drop? Open a short, sell borrowed crypto and buy it back cheaper. The difference is your gain. This isn't traditional investing where you own the coins. You don't receive crypto in your wallet, you're trading expectations. That's why futures are often called trading air. There's nothing in your hands, just strategy and calculations. Have you tried trading futures yet? Drop a comment below. Let's see if that stat about 90% of traders losing their funds really holds up. Long and short, how to earn on price changes. In futures trading on Bybit, there are two main directions, long and short. A long position is a bet that the price will go up. You open a trade expecting Bitcoin to rise. If your prediction is correct, you close the position and earn the difference between your entry and exit price. It's similar to the classic buy low, sell high strategy. But here, you don't actually own the asset. You're trading through a contract. A short position is a bet on a price drop. You borrow Bitcoin from the exchange, sell it at the current price, and then buy it back cheaper once the price falls, keeping the difference as profit. This allows you to earn even in a falling market, unlike spot trading, where profits only come from price increases. Futures stand out because they let you profit in both directions, whether the market is going up or down. If you believe the price will drop, you can open a short and make money while others are just waiting. But keep in mind, shorting is riskier. With longs, the price can rise indefinitely, and so can your profit. But with shorts, the price can't fall below zero, while a sudden upward move can lead to large losses. That's why short positions require caution and a solid understanding of market dynamics. Let's break down the next stage, how to start trading futures on Bybit. When you're ready to start trading futures, Bybit is a great platform to begin with. It's well suited for short-term trades and lets you react quickly to market movements. To get started, go to the derivatives section on the website or in the app. That's where all the futures trading tools are located. Next, choose the contract type. USDT Perpetual. This is one of the most popular options because it's pegged to the stablecoin USDT and doesn't have an expiration date. Then select a trading pair, like BTC USDT, meaning you'll be trading Bitcoin against USDT. Once selected, the trading terminal will open. That's where all the action happens. Before opening a position, you'll need to transfer funds to your futures account. You already have a main wallet on Bybit. From there, you transfer the desired amount, for example in USDT, to your futures balance. It's simple. Go to the Assets section, click Transfer, enter the amount, and confirm. Once the funds arrive, you're ready to trade. Bybit's interface is clean and intuitive. You can easily place longs, shorts, stop losses, and take profits. We'll go into more detail on that later, but even now it's clear, this is a solid platform for managing both risk and reward, even if you're just starting out. And here's a bonus. If you register using my referral link, you can get up to $30,000 in bonuses. The link is in the description. Use it to give your trading journey a powerful boost. And so, the next stage is leverage, how it increases both profit and risk. Leverage in futures trading on Bybit allows you to control a position much larger than your actual capital. Let's say you have $1,000 and choose 10x leverage. That means the exchange lends you an additional $9,000, so you open a position worth $10,000. You're trading a futures contract, for example on Bitcoin, and now every price movement affects the full 10,000, not just your initial 1,000. If you go long, you're betting on the price going up. Let's say Bitcoin rises by 10%. Your profit would be $1,000, even though you only invested $1,000. Without leverage, you'd make just $100. So leverage amplifies your gains, but also your losses. Here's the risk. If the price drops by more than 10 to 12%, your losses exceed your margin, and the exchange will automatically close your position. This is called liquidation. You lose your entire deposit because it's no longer enough to cover the losses on the contract. That's why risk management is crucial. If you're new to futures, it's better to start with lower leverage, like 3x or 5x, to reduce potential losses if the market moves against you. Bybit also offers a liquidation calculator that helps you estimate the price level at which your position would be closed. It's a useful tool to understand where your risk threshold lies before entering a trade. Now let's break down what margin is, how it affects your trading. Margin in futures trading on Bybit is the amount you put up as collateral to open a position. When you use leverage, the exchange provides additional funds, but part of the position is backed by your own money. That's your margin. There are two main margin modes, isolated margin and cross margin, and your choice affects your risk exposure. Isolated margin means you're only risking the amount allocated to a specific trade. For example, you have $10,000 in your account and open a position using $1,000 as margin. If the market moves against you and the position gets liquidated, you lose only that $1,000. The remaining $9,000 stays untouched. This is a safer option, especially for beginners, because losses are limited to a single trade. Cross margin works differently. Your entire account balance can be used to support an open position. Let's say you start with $1,000 in margin. If the price moves against you, the system can draw from the remaining $9,000 to keep the position open. If losses exceed your total balance, you lose everything. This is a more aggressive approach. One bad trade can wipe out your entire account. For new traders, isolated margin is the better choice. It helps limit losses and gives you more control over your capital. Cross margin is more suitable for experienced traders who actively manage their risk and monitor positions closely. Choosing the right margin mode is a key step. It defines how much you're willing to put on the line in each trade. Now let's talk about a critically important topic. Risk management. Without it, it's nearly impossible to trade futures consistently, especially when using leverage. Risk management is the skill of limiting losses and protecting your capital. Without a clear strategy, even a couple of bad trades can wipe out your entire account. This is especially true when using high leverage or cross margin, where your whole balance is at risk. Bybit offers several tools to help manage risk. Stop loss orders automatically limit your losses. Isolated margin protects the rest of your funds from a single trade. Liquidation calculator shows the exact price at which your position will be closed, but the most important thing is understanding the basics. Even the best tools won't help if you don't know how to use them properly. Want to learn how to manage risk and trade with confidence? Join our Telegram channel. The link is in the description. Next, let's talk about the market and limit orders, what they are and how to use them. Market and limit orders are the two main ways to open a position in futures trading on Bybit. They let you enter the market either quickly or with precision, depending on your strategy. Market order. For those who want to enter a trade immediately, you simply enter the amount, for example 0.1 BTC, and click the button. The trade is executed instantly at the current market price. Yes, you'll pay a small fee, around $3 for example, but you won't miss the moment, which is crucial during fast market moves. The key advantage here is speed. Limit order. For those who want to enter at a specific price, you set the price level at which you're willing to open a position and wait for the market to reach it. For example, if you want to buy Bitcoin below the current price, you place a limit order, and it will only execute if the price hits your target. This gives you more control, but there's a chance the trade won't open if the price never gets there. On Bybit, you can customize your orders flexibly. Set the amount in BTC or the total in USDT. Choose your margin type. Let the system auto-calculate how much crypto you'll get for your input. Understanding the difference between these order types is a key step toward trading with precision and confidence. Finally, let's talk about stop loss and take profit and why they are important. Stop loss and take profit are essential tools that help you manage trades in futures trading. They allow you to predefine your exit points, either to limit losses or to lock in profits. This is a key part of risk management that protects you from sudden market swings. A stop loss is a protective order that automatically closes your position if the price moves against you. You set a level where you're willing to exit to avoid losing more than planned. For example, you open a long position, but the market starts to drop. Once the price hits your stop level, the position closes. This is especially useful if you can't monitor the chart constantly. The system handles it for you. A take profit order locks in your gains when the price reaches a target level. You define in advance where you want to exit with profit, and once the market hits that point, the trade closes automatically. This helps you secure profits before the market has a chance to reverse. You can set these orders right when opening a position, or add them later as the market moves. For example, when you enter a long, the price starts rising. You place a stop loss just below your entry, and a take profit above. This way, you stay in control. Losses are capped, and profits are secured at the right time. For beginner traders, these tools are especially important. They make trading more structured, calm, and predictable. What is a trailing stop and why is it needed? A trailing stop is a special type of order that helps you lock in profits as the market moves in your favor. Unlike a regular stop loss, it doesn't stay fixed. A trailing stop automatically adjusts as the price rises. It's a great way to protect your gains if you're already in profit, but don't want a sudden reversal to wipe it out. How it works. Let's say you open a long position and set a trailing stop with a 3% offset. As the price goes up, the stop moves up with it, always staying 3% below the highest price reached. But if the market reverses and drops by that 3%, the order triggers and your position closes. You lock in profit without waiting for the market to eat away your gains. Example, you enter a trade, the price climbs, the trailing stop follows. Once the price peaks and then drops by your set percentage, the position is closed. You don't lose the entire move, you capture a solid portion of the upside. This is especially useful in futures trading, where volatility is high and reversals can be sharp. Why it matters. A trailing stop gives your trade room to grow while still protecting your profits. It adjusts automatically, so you don't have to manually update your stop loss every time the price moves. It's a smart tool to help you secure gains when you're already in the green, and not let the market take them back. What are conditional orders? How to trade based on market signals. A conditional order is a way to automatically enter a trade when the price reaches a level you've set in advance. It doesn't activate right away. It only triggers when a specific condition is met. This is especially useful if you can't monitor the chart all the time, but still want to catch the right moment to enter the market. How it works. You set a trigger price, the level at which the order becomes active. For example, expecting a breakout to the upside? Set a conditional long order. Once the price hits your trigger, the position opens automatically. Anticipating a drop? Set a short order with a trigger below the current price, and the trade will execute when the market reaches that level. Why it matters. Conditional orders let you plan your entry in advance and avoid missing opportunities if the market moves quickly. This is especially valuable in futures trading, where timing can be critical. You get both precision and automation. The system handles the execution for you, even if you're away from the screen. And now, a bonus for those who made it almost to the end. Let's go over a few more helpful tools that can make your futures trading even more confident and effective. Adding margin. If your position is close to liquidation, you can add more funds to push that critical point further away. For example, you started with $500, but the market moved against you. You add another $500, bringing your total margin to $1,000. This reduces the risk of liquidation and gives your trade more room to recover. Multiple take profits. You don't have to close your entire position at once. You can take profits in stages. Let's say you open a long and set 3 targets. The first closes 30% of the position. The second closes another 30%. The rest stays open in case the price keeps rising. This way, you lock in partial profits while still giving the trade room to grow. Trading automation. Bybit offers a futures grid bot that automatically opens and closes trades based on a preset price grid, earning from market fluctuations. There's also copy trading, where you can follow the strategies of experienced traders and have their trades executed on your account automatically. Now you know how to trade futures smartly and with confidence. If you want more tips, market insights, strategies, and real-world examples, be sure to check out our Telegram channel. The link is in the description. Don't forget to like the video, share your thoughts in the comments, and let us know what topics you'd like to see next. See you soon. We've got even more valuable content and practical breakdowns coming your way.